Hello, everyone. I'm Susan Sarava with Comerica's marketing team. Thank you for joining us for this LinkedIn Live. I am joined today by Bob Buchanan, and he is our head of transition planning here at Comerica. Bob, welcome.
Thanks, Susan. Great to be here.
Great to have you here. Today, we are talking about what to consider when you are going to buy out a business partner. So this is something that's very common for business owners. Tell us how often is this happening?
Well, I would say very often. It's hard to know exactly, but there are a lot of business owners who have partners, and frequently the timing of exit of those partners is not the same. One might want to stay, one might want to leave, or maybe there are multiple partners, and it's very difficult for their individual timing to match their business timing exactly.
Today, we have a number of subjects to cover. Now, the first one we're going to go over is let us know about how many companies are thinking about this over the last 10 years or within a 10-year period. We have an interesting stat there. Tell us about that.
Yeah, I'd like to start with this slide, not just because it shows that a lot of people are thinking about the same thing. A lot of time business owners think that they're on an island and they're the only ones having these thoughts, when in fact, a majority of business owners are thinking about transition over a fairly short period of time. The other reason I really like this slide is that there's a statistic on here that just always kind of makes me smile, that 7% of business owners say that they'll never transition. And that's obviously a fallacy. Everyone is going to transition at some point, whether they plan that or not. The hope is that that transition takes a form that is pleasing to them and isn't because they get sick or their business gets in trouble or maybe even a death.
Okay, so advanced planning is very important, and having these types of conversations really matters. So thank you for mentioning that. Okay, the next slide that we're going to put up here is about ways to transition. Give us an idea of the variety of ways that people can transition a business.
So there are all kinds of ways to transition. People can keep the business in their family and transition to their children by gift or sale. They can actually just hold on to the business and transition out of management and day-to-day operations by bringing in a management team. They could sell their business to a variety of different types of buyers. They could sell to their management team. They could sell to outside buyers. They could sell to their employee base through what's called an employee stock ownership plan. There's just all kinds of ways to transition, or they could do a combination of transitions. So today we're really going to focus on not really buying out your business partner, but selling to your business partner.
Okay, that makes sense, Bob. Thank you for mentioning that. And I know you have these conversations with people all the time. And this can be a very emotional time and a time where it can be overwhelming. So tell us a little bit about how you connect with people to make them feel calm and just give them some education on what to do.
So we really start, Susan, with personal planning. We help them understand what it is they need to achieve and what it is they want to achieve and the difference between those two things. And then we also help them understand sort of the economic impact of emotional decision making. There's nothing wrong with making a decision that makes you happy as long as you understand the economic impact of it. And so transferring to your children might be what you want to do, but that might not get you the highest value from your company. And if you don't need the highest value and the utility you get from transferring to your children outweighs the economic value that you give up, that's okay. But as long as you know that. So we really help people understand the balance between qualitative and quantitative aspects of transition.
Okay. All right, Bob, let's move on to the next subject, and that is the financial requirement. That's something that is a very serious part of this. So explain to us more on that.
I always try to start with personal planning when we're talking about business transition planning, because if you can't meet those personal financial goals, the entire business transition plan sort of becomes moot. And what I mean by that is if you know what you need for the rest of your life to meet your goals and meet your objectives, and even stretch goals. So what are the philanthropic things that you want to do with the rest of your life? How much money do you need just to pay your bills? Do you want to travel? What are the other things that you want to accomplish? Put your children or grandchildren through college, whatever those things are. Understanding those is really the first step. And that shows you what the need is. then you have to sort of calculate whether or not you can fill the gap if there is one. For many people, there's not a gap. They already have enough money as business owners. They've taken enough out of their business over a long period of time to meet that need. But if there's a gap, then you have to think about whether or not the business can meet the gap and how you want it to meet the gap. Is it through selling the business and getting liquidity, getting the value out of the business, or is it through ongoing operations, or maybe a combination? And so this slide kind of points out that there is a financial need that really has to be considered first. And if you skip that step, if you don't do the personal financial planning, then at the end of the day, you're going to look back and you're going to regret what you've done in transition.
And Bob, is there ever a time when you're too early or too late to do this type of planning?
I would say you're never too early to do this kind of planning. There are times when maybe you're a little too late. It doesn't mean that you can't make it work for you. But if you've already signed a letter of intent to sell your business and you haven't done the personal financial planning and you really don't know if you're going to meet your needs, you might be a little bit too late. But I would say still, you can start the planning at any point. You might just have to adjust your lifestyle instead of your transition plan.
Okay. All right. Good advice there. Okay. Next slide. We're going to talk about the focus on transferring to an existing business partner. What is that process like?
Well, so when you're thinking about transferring to an existing partner, there are a lot of factors you've got to consider. First is the personal financial planning. Can you meet your goals this way? But then a lot of business owners think that it'll be easier to transfer to an existing partner because they already have a relationship with them. They already know the business. There's a lot of things happening there that kind of make it simpler, but those same factors can make it more difficult, right? You've already got a relationship. They already know the business. They have an idea of value. They know what it takes to run the business. And maybe their idea of value for your shares isn't the same as yours. And it could be a lot more difficult to negotiate with someone that you have a long relationship with, maybe your friends or maybe your relatives. And so the juxtaposition there of these two columns on this slide, the things that make it easy are also the things that make it hard. And you really have to sort of walk a very fine line through a negotiation process when you're talking about selling to an existing partner, especially if you have a good relationship with that partner. And there are a lot of things that can make that easier. And we'll talk about some of those coming up.
Okay. So sometimes it could be easier to sell to a stranger, sometimes to an existing business partner. It's a case by case basis, correct?
Absolutely. Yeah.
Okay. We do have a couple questions that came in on LinkedIn, so I'm going to hang on to those and get to those after we go through another few subjects here. Okay, now let's talk about the important considerations that every business owner needs to think about before they take any of these steps. Tell us about those.
Yeah, particularly in this scenario, right? When you're selling to an outside party, a lot of these things are important, but when you're selling to someone that you know, and you're doing it in a way that might be very different than a sale to an outside party, it's really important to think about these things kind of step by step. And the first is whether there is an existing buy-sell agreement. Because if there's an existing buy-sell agreement, it could control the way that you sell and the price that you get. And a lot of times people are happy with that. They have lived with that their whole lives. But a lot of times at the end of the day, maybe that buy-sell agreement doesn't reflect the value that you need or the cash flow that you need. And the negotiation around that transfer to an existing partner might be very truncated because there's an existing buy-sell agreement. Or maybe those existing partners are willing to go outside of that agreement. Secondly, there's a question of valuation. And oftentimes with business owners, valuation is extremely important. They've spent their life building a business and they want to get the value out of it. And other times when I've talked to people and they say, I want to get full value, what they really want is to make sure they have the cash flow they need to live the rest of their lives. And that might not necessarily imply getting full value. And so there's a question there. Are you really after value, or are you after a reduction of risk in your cash flows as you move forward? And that brings up risk assessment. And so the next question, and all of these sort of tie into each other, the next question is, how much risk are you willing to take going forward compared to what you took as you were operating the business. Because in a transition to an existing partner, typically you're not going to get all cash. And we'll talk about that in just a second. But oftentimes that transition means that you're going to be holding a note, and the partner is going to pay you over time because they don't have the cash. And maybe they can borrow some of it. Maybe they can borrow all of it and you get to walk away with cash. But if you don't get all cash for your interest, then you're taking risk over time. And the question is, what are you being compensated for that risk, and how much risk are you taking? And so those considerations are absolutely paramount in going to structure the transaction. And that's the next issue. And structure isn't just about cash and notes. That's what we have here, but it's about more. It can be about more. And so buy-sell agreements sometimes are redemption agreements and sometimes cross-purchase agreements. A redemption is where the company buys out your shares, buys out your interest, and a cross-purchase is when the shareholder themselves buy out your interest. Now, to you, there's not really a very big difference. You're getting cash either way, or you're holding a note either way. The difference is in maybe the risk that you take. Whether the company is subject to pay you back might be less risky than a partner, or if the partner is subject to pay you back, maybe they're less risky than the company paying you back if they're responsible for the note. Secondly, there is a tax impact to the buyer. And so if the partner is buying you out, they establish basis at the new value that they're paying for those shares. If the company's buying you out, they're retiring the shares, and the partner's ownership interest just goes up automatically, but his basis doesn't, or her basis doesn't. And so there's a tax implication to them. That could be covered in a buy-sell, or maybe not if there's not a buy-sell, in which case this is all a negotiation. And so when you're thinking about how to structure, all of those prior issues, valuation, risk, all come into play, because you want to make sure that that structure gives you the risk that you're comfortable with, gives you either valuation or cash flow that you're comfortable with, and does the same for the other party. You can't put the business in a situation where the cash flow that you need straps the business or straps the other owner. So everything has to be worked out in a way that it works for everybody. And that's where it can get challenging, because the seller, you, may have a very different need than the buyer or the company. And when you add all of these things together and think about them sort of as a total package, is when you're really getting to the nuts and bolts of what you have to do in a transition to existing owners.
Bob, so it sounds like business owners should be prepared for lots of negotiation as they're going through each stage of this.
I would say yes. Again, unless you have a buy-sell agreement that really outlines exactly what you're going to do and everybody's happy with that, then I'd say, yeah, be prepared for a lot of negotiation, maybe less negotiation than you would have with a third-party buyer, but maybe a more difficult negotiation. Okay.
And do a lot of businesses have these buy-sell agreements in place? Is that common?
So I would say it's pretty common. A lot of times the buy-sell agreement sort of develops over time. My advice to people is always make it clear from the beginning. And you can always adjust it over time if you need to. But trying to sign a buy-sell agreement later, when maybe not everybody wants to sign it, can be very challenging.
Yeah. Okay, understood. While we're on this slide, I do want to address a question from Melissa, and getting back to the valuation. She is asking, could you talk more about the difference between value and cash flow?
Sure. So oftentimes, especially if there's a buy-sell, valuation is defined, and it'll be some number of times earnings before interest and taxes, or some multiple of revenue, or some multiple of book value, or something like that. And that valuation typically is also within a structure of a transaction. And so a buy-sell agreement might say, we're going to buy the seller out over 5 years with 20% down and 20% a year at 6% interest. That valuation is different than the cash flow you're going to receive. The cash flow you're going to receive is the 20% per year with 6% interest. When I'm talking to sellers, business owners, oftentimes they have an idea that they need full value. And if a buy sell doesn't exist, then they start getting hung up on what that valuation is. And sometimes that will derail a negotiation with an existing partner because the partner might not have the same idea of value or might not want to pay the same value. If instead what the seller really needs is security in cash flow over a period of time because they're giving up their salary or they're giving up their distributions, then it's important to recognize that. And so through a series of conversations, you can help people figure out what it is they're really looking for. Now, if they don't need the cash flow and value really is what's important, then we negotiate value. But if value isn't what is important, if that cash flow over 10 years or 20 years or whatever that period is what's really important, you can back into the cash flow without being concerned about the valuation. And maybe you can solve everybody's problems by considering one or the other.
Okay. Lot to discuss there and think about. Okay, Bob, so let's move on to our key takeaways from this presentation today. We have three that you really want people to be able to walk away with.
Yeah, the first is the same from every one of these discussions, and it's always understand what your needs are. And that's starting with the personal planning. If you don't do that, then you're taking a step off a cliff. You have to have the understanding of what you really need to start any of these transition processes. Second is understand the benefits and challenges of the process you're going through. Understand going in that selling to an existing shareholder, someone that you have a relationship with, might affect that relationship. And understand that they already have this understanding of the business that might make it easier and might make it more difficult. And finally, again, with almost anything, create a structure that works for everybody. In this case, both parties, but suppose there are 10 shareholders. You've got to create a structure that works for everyone. In a sale to a third party, you have to do the same thing. But when you're doing it with an existing partner, with an existing shareholder, it's even more important because of those emotional attachments, because of those long-term relationships, because of the risk you're taking as selling to a shareholder versus getting all cash from a third-party buyer. Creating that structure that gives the buyer the tax implication that they need or reduces their risk in a way that is comfortable for them is the key to getting this kind of a transition done. Without really considering everybody in the transition, a seller is doing a disservice to themselves.
We have a question from Brad, and this gets back to the buy-sell agreements that we were talking about earlier. And the question is, if my partners have a buy-sell, do we have to stick with the provisions in it, or can we do something different?
Yeah, and so I started to talk about that. The buy-sell is an outline that if everybody's happy with, works great. Going outside the buy-sell requires everyone's involvement. And so you can't sort of unilaterally say, I'm going to negotiate something different than the buy-sell requires. If everybody's on board with that, if you have one other partner and that other partner says, hey, I'm okay with that, let's create a structure that works for this situation, then you can go outside the buy-sell as long as everybody's okay with that, right? You're creating a new contract. But if you have, let's say, 5 existing partners and 2 of you want to go outside the buy-sell, but the other 3 don't, you're kind of stuck. I mean, you've signed an agreement. That agreement is binding. It's binding upon everyone unless everyone says we're going to change it. Unless there are provisions in the existing buy-sell which allow it to be changed by a certain vote, and you and the person that you want to change with control that vote. Or if you control that vote yourself, if you have 60% and it says you need 60% to change the buy-sell, then you can change it.
Okay, so it's really important when you put the original buy-sell in place that you hammer out all these details, correct?
Absolutely, and that's when creating a buy-sell, that's why I said it's very important to start very early, sort of hammering out a buy-sell after everybody's already a partner and an owner. If people don't want to agree to it, then you can't get it signed. It has to be signed by all of the shareholders, at least initially. And so very difficult to create a buy-sell later. Much easier early when everybody walks in with their eyes open and understands their rights and responsibilities.
And Bob, when business owners are going to this stage, is it mostly because personally they're ready to move on or retire or something like that? Or do they take into consideration what's happening in the economy or other factors?
It can be a variety of things. Oftentimes, when people are transitioning from their business, it's because they've been there long enough, they're ready to retire. But a lot of people will transition before they're ready to, quote, retire, because of risk aversion. Or, in 2009, when we started coming out in 2010 of the Great Recession, there were a lot of business owners who just didn't want to go through that again. They were
Mhm.
still fairly young. Their businesses had a decent amount of value, and they did the planning and decided they could live on what they got from it. And so they decided it was time. Coming out of the pandemic, we've heard a lot of people say the same thing. I just don't want to go through this again. I don't know what risk is around the corner. I thought I had a good handle on my business. Everything was going fine, and then this happened. I don't know what's next, and I don't want to deal with what's next. And so sometimes it's a risk, sometimes it's economy, sometimes it's the exact opposite. Sometimes the business is doing so well and the company has become so valuable that an owner just decides it's time. I can get more for it now than I'll ever get for it in the future, and I should take advantage of that.
Yeah, sometimes you just want to go with your gut instinct, right?
Yeah.
Okay. Well, we have another question here from Chris here on LinkedIn. Is it riskier to take a note back from my company in a redemption or from my partner in a straight purchase?
Um, there's not a great easy answer for that. It depends on the risk of your company's cash flows and your exit, and the risk of your partner's cash flows. So if the company takes on the debt in a redemption and buys out your shares, and oftentimes the company maybe can pay you more cash than your partner could, but not always. But if the company takes on that note, then the debt to you is from the company. And so all of the assets of the company support that debt. Now, assuming that the valuation is correct, there should be more assets in the company than your shares are worth, because you're not selling 100%. You're selling something less because you already have a partner. We know there's an existing partner who owns something. So one would think that the shares, or I'm sorry, the note is backed by enough assets to cover you if the company could stop paying. The question is, how risky does the company become at your exit? Do those cash flows get affected because you're gone? And the same question gets asked if you're getting bought out by a partner, because the partner may be dependent on the cash flows from the company to pay off the note that the partner has to you. However, the partner may have outside assets beyond the assets of the company that exceed the value of the note as well. So it really sort of depends on an underwriting exercise, if you will. How risky is the partner versus the company? I say in general, I would want the note to be backed by the company rather than the partner. But that's not universally true.
Okay, Bob, well, you shared so much knowledge today. We so appreciate that. I just want to ask before we close this out, any final thoughts or words of wisdom you'd like to tell us?
Yeah, don't be that 7% in that first graph of people who think they're never going to transition. Start planning. Start planning early. Start thinking about how you want to exit, who it affects and how it affects them, and how it affects you. Because when you start thinking about those topics, it opens up a huge array of questions. And as you answer those questions, it'll lead you to the path that works best.
Okay, makes a lot of sense. All right, Bob, thank you so much. And thanks to all of you who watched us on LinkedIn Live today. And for the questions, we really appreciate that. And have a great rest of your day, everyone.
Thanks, Susan.